Welcome back to the Scholar Wealth Podcast. Today we're covering a wide range of topics from how to set boundaries when your kids want to invest in their assets, to whether direct indexing is worth the complexity for tax loss harvesting, to the financial logistics of hiring a private chef at a family property. And in our Term of the Day segment, we'll break down QSBS, or Qualified Small Business Stock, which can be a powerful tax planning opportunity for the entrepreneurs out there. So let's get started with question one.
We regularly gift to our 23-year-old daughter, and she recently asked if she could invest $50,000 of her account in crypto. We want to encourage her interest in investing and let her explore new asset classes, but we're also worried about it becoming an expensive lesson. What are smart parameters we can set around learning capital without micromanaging?
So this is a great question to jump into around really a couple different areas or angles that you're dealing with. One is the separation of autonomy here and also protecting good financial habits or the actual financial capital that's available, which is one of the difficulties that a lot of people have with gifting to your kids is you go gift them the $19,000, whatever the limit is, and they say, well, can I control what they invest in? And you can't at all. You have no say over that. That's the entire purpose of the gift, is that once you gift that money over, it is no longer yours, it's theirs. So now we run into this problem, which is not uncommon, where at first, a lot of times the kids don't want to touch the money, but now it's starting to become interesting, and you're now dealing with a situation where you're looking at $50,000 Bitcoin in the amount that you've gifted. So be careful about this. So I think if we take a step back and think about this as the good things and the possibly dangerous things around this scenario. The good thing is that your daughter seems interested in finance, is interested in crypto, interested in the overall financial markets that are there. So I think that's a really important thing to have as a hurdle that a lot of people can't get over. So the fact that that's been done is really helpful. The next is to start thinking about this learning capital as a small percentage of investments. We all know people who, or yourselves, have a small portion of investments that are fun money. It's the gambling component of the wealth. It's the small stocks. It's the stock that you were pitched in a golf course type of scenario that we all have seen and have heard the horror stories of when it all blows up. And that's what your daughter's going through now. There's something exciting out there. There's a shiny investment that's earning people a lot of money in the crypto world. So this is a great time to bring in this concept of diversification and just saying that there's nothing wrong with investing in alternative asset classes or risky asset classes, as long as there's limits associated with that process. So going over things like, what should the core portfolio be that she's invested in? Maybe it's her age, mostly stocks, my guess. So large equity position, and then a small percentage, maybe 5-10% of assets that she can allocate toward more risky ventures that are out there or things that are a little bit more volatile. And then look at that and say, all right, well, now you have this component that's this 10%. How should we divvy it up? Do you want all of that to go into Bitcoin? Do you want to split it up into a couple different cryptocurrencies? And this is what I would suggest, is to look at something like some of these ETFs that are out there that focus on cryptocurrency as an entire industry. So you get some of the miners, you get the Coinbase exposure, you get the chip exposure. So it's all crypto adjacent, but it's not necessarily all crypto. So you're starting to show her that it's not just a cryptocurrency investment in one coin, it's cryptocurrency investment as an industry as a whole. So I think it's a great way to go about it. I would take the win of your daughter being interested in financial markets, use this as the opportunity to teach her a little bit more about how you would think about a portfolio, how you would diversify that portfolio, and start to build out that autonomy as an investor and having her build out her investment philosophy herself. But I think you're going to have to chalk up this one, depending on how much it is, to more of a tuition associated with learning about the markets as opposed to trying to restrict it whatsoever. But I definitely need a huge percentage of assets rolling into any alternative or any risky component of the portfolio. So now on to our next question.
I built a $6 million portfolio mostly in taxable accounts. A friend suggested direct indexing could give me an edge on tax loss harvesting, especially since I already donate appreciated stock to our donor-advised fund. Is it worth the complexity?
The direct indexing game is something that we've heard a ton about the past few years. I mean, 5 years ago, you never heard about it. Past 2 years, maybe 3, it seems like everybody's being pitched the whole direct indexing portfolio that's there. I personally think that this is the response to the push away from active management of investing and back into something more passive. So if you think back in the history of how money is made on Wall Street, you start with active management, and then the active management is give me your money in the portfolio, I'll pick the best individual stocks. And that kind of blew up in the 70s with different research that came out, and we really started seeing that it's hard to beat the market. Definitely ends with things like the Fama French models and everything in the early 90s. So then that kind of goes out the door. You see this big rise of index investing after Bogle starts Vanguard. So you have this big push toward passive investing. And now if active management is out, then passive management is in, then how can you as a broker add value to an individual portfolio if you're not doing any planning or anything like that? You can't say, I'm going to pick the best individual stocks for you, because that's a hard sell to make in a world when there's so much research against that. So there's really been two directions where I've seen this grow. One is alternative investments. So we're starting to see a big increase in access to private equity funds and other types of real estate syndications. And even now starting to see some of that show up in even retirement accounts, which has its own issues associated with it. But we're definitely seeing that as the new pitch of, well, I can't pick the best individual stocks for you in the public markets, but I could definitely pick the best private companies for you in this private equity fund. So that's one path. The other path is this direct indexing path. The direct indexing path is, we know you like the index funds. So what we're going to do is we're going to invest you in, let's say, the S&P 500. And then what we'll do is some of the stocks in the S&P 500 today are going to be up and some of them are going to be down. When they're down, we'll sell them, and then we'll capture the losses from those individual stocks. And then we'll go buy another stock that's correlated with it. So that way you don't lose the exposure. So over time, you still have very similar exposure to the S&P 500, but you've been able to generate all these losses that offset gains in the portfolio. So from a 10,000 foot view, there's nothing wrong with that process. That is true. That is how it's done. Where it becomes a problem is in the weeds of how it's done. For instance, an example that always shows up. If I had a doctor, every time a client told me, explained this to me and said, well, they told me what they'll do is when Pepsi's down, they'll buy Coke, and they'll just go through this whole process. And there's not really a great comparison. There's two totally different companies. Pepsi's a chip company and Coca-Cola is a recipe company for all intents and purposes. And the issue you run into is in that scenario, let's say you have Coca-Cola goes down and they capture that loss. So they're going to sell Coca-Cola in the portfolio and they're going to go buy Pepsi. And they've captured the loss for Coca-Cola. You're going to be able to write that off this year, and now you've bought Pepsi. Now, eventually what they're going to have to do is they're going to have to go and sell all of these securities that you're buying at higher and higher price points. So Pepsi's up, Coke's down, right? So we sold this at Coke at a low price. We bought Pepsi at a higher price. Well, if we continue this process and we continue to buy back and forth, eventually we're going to have to buy back Coke, and we're going to buy back Coke at a lower price point after 30 days, generally because the laws that are associated with it. And we bought Coke at a lower price. So every time we take a loss, we're capturing that loss and buying something else at a lower price point. If we continue that process where you have Ford drops in price and GM drops in price, you sell your Ford, you go buy GM. They're correlated, they're moving together. Now you bought GM at a low price. What eventually happens across your 500 stocks in your portfolio is you've purchased all of these stocks at lower and lower prices, capturing all the losses in the fund. So what happens when you have now 500 stocks in your portfolio that are all at a lower basis and markets trend up? You move away from that basis. So the odds of you ever getting to a loss again is really, really low. So while the tax benefits of direct indexing are absolutely true up front, over time, the benefit that you receive from the tax loss harvesting decreases pretty significantly, especially after the third and fourth year, because of the market trending up over time and your basis at all of these individual stocks being lower and lower. So can it work? Yes, up front. Does it work consistently? No, because you end up having lower basis in a trending market that goes north. That's not even the worst part that we tend to see is some people look at that and say, well, that's great. I just need a few years, tax savings. It's fantastic. The only problem is you're paying a fee to have someone direct index your portfolio. So if they're direct indexing your portfolio and they're dealing with all this and they're charging you 30 bips, 70 bips, worse if they're charging 100 bips, you probably shouldn't do that. But you have a portion of your portfolio going out in fees every year. What happens 3 years from now? 3 years from now, you now own a portfolio of 500 individual stocks in your portfolio. Mind you, you don't own an ETF or a fund where it's one thing. You now have 500 different positions in your portfolio, all with very low basis. And now you're stuck. You're paying a fee on funds that you can't tax loss harvest anymore because the basis is so low. So maybe a couple of them jump up high and then take a loss and you can go through there. But eventually in the limit, what ends up happening is a ton of individual stocks with embedded gains that you can't get out of. And your option is to continue paying the fee for management on this portfolio that's actually not providing you any of the big benefits they promised anymore. Or you could anytime close out the active management account. And now you personally can have a portfolio with 500 different individual stocks that you now have to manage, which is horrible. I think it's one of the biggest problems right now in financial markets is this direct indexing idea, because it takes something that everyone hates, which is taxes, combines that with a really simple concept that is, we have two stocks moving together. When they both drop, we'll sell one, we'll buy the other. And they forget or don't say what happens 2 or 3 years down the road when you have to unwind all this stuff. And that becomes a problem. You can do some of this with some ETFs. You can split the S&P 500 up into value and growth. Or you can split the S&P 500 up even into 10 sectors. And doing that will give you a lot of that same ability to tax loss harvest throughout the year without having anywhere near the complexity of all these individual stocks in the portfolio. So keep an eye on that one. It's not something that I would be jumping into. Where it really can work is if you're constantly throwing money in. If you're constantly throwing money in, then that new money that you're throwing in there is going to have a higher basis. So when it drops, you'll be able to take some of that tax loss harvesting option. But again, as markets go up, every dollar you put in before is less likely to have a basis high enough for you to ever take a loss in the future. So we want to take that into account. The DAF component isn't too much of a concern because you've already put appreciated securities into the DAF, unless you're just getting to the fact of because you have the DAF, you don't have to worry about the appreciated stock on those shares for the donor advised fund. But funny enough, I guess if you really like DAFs, this could work out really well because you get into a direct indexing portfolio, you're going to end up with a lot of concentrated positions. And then you'll want to have to use the DAF again to get out of them all later on down the road. And we go into our final question of the day.
Our grandparents' Nantucket home is in a trust that my siblings and I rotate using throughout the summer. We've been talking about hiring a private chef for the season to cook for our families when we're there and also help with bigger get-togethers. The sticking point is how to structure it. Are we talking about an independent contractor or an actual household employee with payroll and insurance? And would it be appropriate for the trust to cover this expense, or should each family contribute separately?
So let's start with the ending question first. That's the broadest one, the easiest answer, because it really depends. I know it's a horrible response to that question, but trust can be structured so differently. If it's just, it was a trust, but is now yours, or it's just more of an ownership split that's there, my guess is you probably could run some of the expenses out of that if the money is there. Really depends on what structure of the trust. Is it just the house? Is it a house with a fund that was meant to fund just home expenses and maintenance? If that's the case, then you're maintaining yourself through a private chef is probably not going to be a justifiable use of trust funds that were there for the house, which is typically the case in that scenario. Now, if there's another trust or there's a component of it that has a lot more discretion of how it can be used, then I don't see that being an issue. But that's absolutely a topic to discuss with the attorney on the trust to make sure that you're not breaking any rules on disbursements to the trustee there. Now we can get more into the details of this. So the common request that comes up, we see it a lot with not only chefs, but also shows up with groundskeepers, or most commonly is the nanny kind of concept of, I have someone here taking care of the kids. How do I pay them? Do I need to pay them as a contractor? Do I need to pay them as an employee? How does that work? Do I need a business now because I have employees? All of these things start to come up. So let's start broad first on this idea of contractor versus employee. In your scenario, the issue that you're going to run into is the short-term nature of the contract. So if you're only doing this for summer, that's going to open up a lot of different issues anyways, because it's probably not worth jumping through a ton of hoops to set up payroll and insurance and everything for a couple months for an employee, only to have the employment agreement dissolved at the end of the summer. That's going to be more difficult. Not impossible, but more difficult. If that's the case and you're going to be very narrow on that, then it may be worth reaching out to these agencies that will provide private chef services for you. So they're the business, they're doing the payroll, they'll send somebody in to cook the meals, handle events and everything. That generally is the easier way to go. If you are looking for a little bit more control over the entire situation and have somebody dedicated to you or to the house, in this case, for the summer for you and your family, then you're going to go the either contractor or employee route. The decision is the same decision you have to make as an employer with the contractor and employee route of how much control do you want? If you are supplying all the supplies, meaning like cooking utensils, any types of gear that's needed, so to speak, or any type of equipment, then that is starting to lean you more toward the employee side. If you're controlling what hours are worked, where they work from, all of these, that's pushed more toward the employee side. Things like contractor, they're going to have flexibility to work when they want, from where they want, but they're also going to be responsible for their own tools of the trade. They're going to be responsible for paying for all that. The ease of the contractor is definitely higher. You should write a 1099 or provide a 1099 at the end of the year to the contractor. You pay them over $600, which you would in this case, and they would receive the 1099 they'd pay taxes on. If you're having more control with hours, timing, tools of the trade, all of these different things, then that pushes more on the employee side, and you will need payroll, insurance, workers' comp, all of those things will need to exist for the employer role or employee role. Now, what you need to be careful of is, regardless of what route you go, you will need to sign, and this is a really subtle point, but I think it's an important one for what you're dealing with, one that I think a lot of people think of when they get into it, and is the EIN number and social security numbers that are associated with it. Because you're not a business, and this is a household employment scenario, what's going to end up happening is when you go fill out the 1099 or W-2 forms, whatever it is, the government will default to your social security number as the tax ID number. The issue there is you're about to go hand your social security number out to your chef, the nanny, or whoever else on the top of the paper. So you'll want to apply for an EIN. That's an employer identification number. Really easy process. Go online, apply for it. They'll send it to you in the mail. It's basically, if you're thinking about like a business social security number, but in your case, it would just be this separate social security number that's going to pay out all of these different things. When it comes to splitting the cost, whichever direction you go, the best way for cost sharing in this scenario is probably going to separate labor and food, especially if there's different preferences there, or you end up with a cousin who just eats like lobster for every meal, something like that. It starts blowing up the family budget for the house. So to avoid that scenario, food would be purchased separately or reimbursed separately for whatever weeks you're there. Same with events. If somebody's hosting a really big party, then you'd want the food covered by whoever's hosting that or split accordingly. But the labor, you could, especially if you have somebody full-time in the house all summer, then that could easily be split amongst however many cousins and family members you have that you're splitting up for as maintenance of the home or as an additional expense of the home. So really common situation, a good question to have, some really good considerations. I think the big things you really need to take into account are that contractor employee decision and what is the timing here? Are we only talking 2 months? Are we talking about 4 or 5 months, or it's a little longer? Each has their pros and cons. Seasonal employees, it could be really good for you in this scenario, so maybe it's not going to be as big of a deal where you're at. And cost sharing approaches, really having that spelled out very clearly, and think about all the different possible ways this goes wrong. Anytime you're dealing with any sort of business type arrangement with family, you want to make sure everything's very clearly stated of who's paying for what and whose responsibility is it. And for today's rotating segment, term of the day, we're taking a closer look at QSBS, Qualified Small Business Stock. This is one of the most powerful but often overlooked tax planning tools available to entrepreneurs. The idea here is that if you're a C Corp, and this is where a lot of people don't take this into account, is you have to be careful of how you structure the business when you have the sole proprietorships, LLCs, S Corps. This must be a C Corp scenario, but when it does, it allows you potential to exclude 100% of the capital gains on the stock. So real big incentive for entrepreneurship out there. And there are a few requirements that have to be met for you to be able to, because I know that sounds fantastic. A business sell for $10 million, potentially exclude 100% of the gains. But it is a small business stock, right? QSBS. So because of that, it has a limit of $50 million of gross assets. So as long as your business is $50 million or less in gross assets, then you can exclude up to $10 million of capital gains, which is potentially millions of dollars in value there, depending on the sales price and a lot of other factors in your tax rate. But a great one to take into account. And if you're seeing that thrown around, or if you're investing in companies, there's holding periods associated with this as well that you'd want to dig into. But between the asset size and the possible 100% exclusion of capital gains, definitely something you want to look into if this is your world. And that's it for our show. Thanks for listening, and we'll see you next time. Hey, this is Stephan Shipe. Thanks for tuning in to the Scholar Wealth Podcast. If you have a question you'd like us to tackle in a future episode, share with us at scholaradvising.com/podcast. We'd love to hear from you. Until next time.
Scholar Advising is an independent, fee-only financial advisory firm focused on providing hourly financial advice. The information provided in this podcast is for general informational and educational purposes only, and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your financial situation, objectives, and risk tolerance. Thanks for listening.